Good afternoon. Thank you for joining Corporate Connect. I'm Eileen and I'm your host today. This afternoon, we welcome senior management of Lendlease Global Commercial REIT again, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Mr. Jeff Howie, market strategist from the SGX Group on recent market highlights, followed by the corporate presentation by Mr. Kevin Chow, Chief Executive Officer, and we will end off with a Q&A session. Lendlease Global Commercial REIT is established with a principal investment strategy of investing directly or indirectly in a diversified portfolio of stabilized income-producing real estate assets located globally, which are used primarily for retail and office purposes. Its portfolio comprising leasehold properties in Singapore, namely GEM, and office and retail properties, and 313 at Somerset, prime retail properties, as well as freehold interest in Sky Complex, 3 Grade A office building in Milan. These 5 properties have a total net lettable area of approximately 2.2 million square feet, with an appraised value of 3.6 billion Sing dollars as at 30th June 2022. Other investment includes development of a multifunctional event space on a site adjacent to 313 at Somerset. This afternoon, Mr. Kevin Chow, CEO of Lendlease Global Commercial REIT, will share with us the latest business update. But before this, let's invite Mr. Jeff Howie to give us an overview on how the market performs. Over to you, Jeff.
Hey, thanks very much, Eileen. I'll aim to keep this brief within 10 minutes, just to provide a quick overview before Kelvin speaks. REITs in Singapore, they have continued to attract more than their usual cornerstone share of investor activity. The sector represents something like still 12% of the total market capitalization of the Singapore stock market, but does still make up 20 cents in every dollar that goes to work every single day in our Singapore stock market. And that 12% contribution to total market cap and 20% contribution to turnover of the 40 trusts that are actively traded, it is comparatively high globally, because for some global perspective, you have around $2 trillion of market value in the global REIT sector. And that represents really around 2% of total market cap. So you can see we do push well above our weight in terms of the hub, which has very much become a global hub here. REITs have been listed here since, 2002. And they have been listed in the US much longer, since the 1960s. And they make up now, those US REITs, something like a quarter of around the 850 REITs that are listed across the world. But they do make up 60 to 70% of the total market value of all the big global REIT indices and the whole big global REIT sector. So they're big. And thus the US REITs and their relevant drivers, such as interest rates and economic outlooks, do have a significant impact on the overall tide of the fundamentals and the valuations of the global REIT market. That's the US. The biggest REIT in the world is Prologis. It used to be America Tower Corp, but now it's Prologis, which is an industrial REIT. Trades at around 2 times its book value, has a 40-year history. So it's been running for twice as long as our REIT sector actually is in Singapore, and it has a combined, I think, a current market cap around 100 billion US. So the global benchmark, which this is the biggest component of Prologis, is the FTSE EPRA NAREIT Global REITs Index, and that index is actually flat in the year to date, following its 24% decline in total return last year. And it's coincided, obviously, with this persistent, or as Neil Kaskari, the FOMC voter, has termed recently, darn persistent inflation in the US. And the expectations of the Fed funds rate will remain at this 500 to 525 basis point range right up to the 1st of November at FOMC. That's the majority expectations at the moment. So I guess looking back over the almost 3.5 years, so since the end of 2019, this FTSE EPRA NAREIT Global REIT Index, it has declined something like 12%, while the IHS REIT Index has been a little bit more defensive, declining 6% in total return. So overall, those 3.5 years of returns for the global benchmark and our local benchmark They were pretty much within 5 to 10% of each other, but they do average quite a low rolling correlation coefficient. So that shows that we do have significant differentiation in the day-to-day moves of the Singapore Global REIT Hub and the big global benchmark for REITs. And that's an important point to make for portfolio managers. In Singapore, why do we have this diversification? I guess we have as many as 17 of the trusts exclusively investing in property assets outside of Singapore, and you have 20 of the trusts investing in properties in both Singapore and outside of Singapore. And then you just have the remaining 3 REITs investing purely in Singapore. So for the region, this includes as many as 14 trusts with properties in Australia. We have 11 trusts with properties in China, 11 trusts with properties in Japan, and 9 trusts with properties in the US. Now, while Lendlease Global Commercial REIT sponsor, Lendlease Corporation is part of what we call the Australian institution, known as the Lendlease Group. Lendlease properties are mostly in Singapore, as Eileen mentioned, in addition to that Sky complex in Milan. And Lendlease, I think, was founded, yeah, I do know this because this was part of before I moved to high school in Hong Kong. I had a year of high school in Australia, and that's where we all learned about the tycoon Dick Dusseldorp, who founded Lendlease with, I think, 30 or 40 tradies back in the mid to late 1950s. And this is where this basically this founder of this company has come from. But as I said, backed by a big classic Australian institution, but they don't actually invest in properties in Australia. It's mostly in Singapore, as Eileen mentioned. But more broadly across the S-REIT sector, we've got 80% of our trusts now owning and managing overseas assets from, I guess, across the Asia Pacific, the US and Europe. So that really does make S-REITs one of the world's most international REIT markets now. The average yield of the 40 S-REITs, it was as high as 8.7% at the end of April, but I think a more cornerstone or a more reliable indicator would be the IHS REIT index, which is around 6.4%, because you have had a couple of REITs have declined significantly in their unit prices in recent, I could say, recent quarters, and this obviously does impact that overall average dividend yield somewhat. So if we look at the IHS REIT index, its indicative yield is around 6.4%. Singapore REITs and property trusts, I guess they do continue to diversify in terms of asset mix over the past 3 years, and this has seen diversified S-REITs now make up the largest subsegment of the sector. More diversification can obviously improve a REIT's resilience to external shocks, and it can also allow it to capture growth trends across a whole multitude of segments. The 40 REITs and property trusts of the sector, they ended April with an average gearing ratio of 38%. That's 38%. That's below the regulatory limit of 50% if your minimum interest coverage ratio is at least 2.5 times. That's imposed by the MAS. So if your interest coverage ratio or ICR is below 2.5 times, your maximum allowable limit is 45%. And this ICR is really used to determine how easily your REIT can actually pay the interest on its outstanding debt. And this limit was last increased in April 2020 to provide the sector with more flexibility to manage capital during that pandemic. The 40 REITs also, all of them have all of them have gearing ratios that are within the regulatory limits, and half of them, so that's 20 of the trusts, obviously have ratios below the sector's average. The 3 REITs with the lowest gearing ratios of the 40 at the moment are SIAS REIT, Fraser Logistics and Commercial Trust, and Paragon REIT, and that their gearing ratios are all below 30%. The aggregate leverage limit is not also considered to be breached due to circumstances beyond the control of the manager, such as a depreciation in the asset value of the property fund or any redemption of units payments made from the property fund as well. So that's just an important qualification wanted to mention, as some of those gearing ratios were approaching 50% for certain REITs. CapitaLand, when you look at those REITs, they have 5 trusts now that are part of the sector. And they recently maintained that all listed funds have healthy balance sheets, well-managed debt maturity profiles, and over 75% of the debt is based on fixed interest rates. Now, those 5 trusts have an average gearing ratio of 39% as of the end of March. And that ranges from, I think, CapitaLand Integrated Commercial Trust, which has the highest at 41%. CapitaLand Ascendus REIT is the lowest at 38%. And also, on summing up, on the acquisition front, there have been 5 acquisitions announced this year within the sector. The combined value of those acquisitions is around 2 billion. So this is different, a little bit less to what we saw last year when we saw a dozen or so REITs announce acquisitions, which were basically still not as high as what we saw in the previous year when we saw 20 of the REITs announce acquisitions. So it went from 20 to 12 to so far this year 5 acquisitions announced. Actually, not 5 acquisitions announced, but 5 acquisitions announced in total, which is much less than what we saw from 12 REITs announcing acquisitions last year, and at least 20 REITs announcing acquisitions of previous years. Some REITs have also flagged disposals might be a tool to basically provide the unit holder value that they wish to do over in the coming future. So do keep an eye on that, such as when Suntech flagged that was a possible capital management measure at their disposal. I guess the most recent to announce an acquisition, it was CapitaLand Ascendus REIT, and that's a high specification research and development facility, and its business park as well. And they're acquiring that from Seagate Singapore International. So that will be their Singapore International headquarters, and they're purchasing it for just under 220 Singapore million dollars. I should mention, despite the backdrop of increasing rates, S-REITs are still offering a higher yield spread of between 320 basis points to 330 basis points above Singapore government 10-year bond yields. The last 4 years have seen the FTSE ST REIT index price to book ratio, which is represented by the green line on the right of the chart, basically alternate between a 20% premium to book value, down to a 20% discount to book value, and back to a 10% discount at present, which is, I guess, what has basically been a facilitation, the moves of these, the valuations of this consistent flows that we do have into the S-REIT market. As I said, 20 cents in the dollar every day goes to work in the S-REIT market, and price to book, the premium or the discount that the units are trading to their book value tends to be the key field or the key indicator used by investors from a valuation stance when they come to invest in our REITs here in Singapore. So just to sum up, we do have a diverse market, obviously, but as you can see, S-REITs, they still rank highly in terms of dividend yield when you look at the index versus volatility. So still seen as high yield and low volatility plays. So far this year, on average, the 40 S-REITs are down around 6% so far this year, but there have been REITs that have bucked that trend. Your 5 best performers have averaged something like 12% total return so far this year. That includes Keppel DC REIT, Ames APAC REIT, Cromwell REIT, Fraser Hospitality Trust, and Fraser Centrepoint Trust. So any more information you'd love to have us share, please do. Don't hesitate to contact us. We'd love to hear from you. Here's our QR code for the Telegram channel as well. Okay, so thank you so much, and I'm really looking forward to Kelvin's presentation now.
Thank you, Jeff.
Thanks, Eileen.
Over to Kevin.
Yeah, okay, thank you, Jeff, and thank you, Eileen. I would like to actually cover my presentation pretty fast, given that this is something that we have already published and announced for a month ago, probably a few weeks ago. Okay, let me go to the summary. Okay, basically, as at March itself, I think we have achieved a very good portfolio committed occupancy of 99.8% with a WALE of around 8.3 years. Rental reversion has continued to improve to 3.3% with a tenant sales up 4.6 times. Tenant retention has improved to 79.5%, and we foresee our average rental to be escalate around 4%, which that will be announced somewhere next quarter. Gearing ratio is 39.3% with a weighted average cost of debt 2.51%, and interest rate coverage ratio 4.6 times, and we fixed our borrowing at 61%. Next, please. Basically, we continue to have a very healthy kind of lease expiry profile, and we have already decreased our FY 2023 lease to around 1.4% in terms of NLA and 3.3% in terms of GRI. Occupancy, as mentioned, 99.8% with focused trade sectors of F&B, fashions, and broadcasting. Next, please. The retail continue to achieve a very high occupancy. The average of the two malls is 99.5%, and of course, both of our office buildings are fully leased to Ministry of National Development for Singapore asset, and for Milan we leased to the Sky Italia, which is 100% owned by Comcast. And for those that doesn't know who is Comcast, Comcast is basically the world #1 broadcasting company in the industry by revenue itself, and is highly rated compared to the Italy government. Next, please. So the sales number continue to perform well, and we are, as mentioned, 4.6 times above the sales of year on year, and also we are actually on the visitation we are 2.7 times above our previous year. Next, please. These are our new F&B tenants that we have introduced to the mall. These are some F&B and also some retail tenants. Next, please. Okay, on our capital management, basically our borrowing remain unchanged. The gearing ratios, we are at 39.3%, and with the average debt maturity 2.3 years, with a cost of debt of 2.51% per annum. Interest coverage ratio maintained relatively high at 4.6 times. So we managed to actually refinance one of the debt that is going to mature next financial year, which that will move our debt profile to another, to improve our debt profile by the time it matured. Of course, the new loan hasn't kicked in yet because we're trying to wait until the maturity of the loan, which is in October, before we get it refinanced. But all the documents has signed and everything has been locked in. Of course, the purpose and the reason why not doing it now instead of later is because there's always upfront fee that is paid for the loan, and we want to make sure that we exhausted all the upfront fee before we actually bring in the new loans, so to improve on the value propositions of the loan refinancing. So once we do the refinancing for this loan in October, our total sustainability financing will be around 89%. And the benefit of having a sustainability financing is basically to achieve some kind of saving if we achieve the targets, which I think we are able to achieve the target, and that means that we were able to achieve the saving. And as at 31st of March 2023, we do actually have an undrawn debt facility of around 230.4 billion. Thanks. Next, please. These are some of the initiatives that we do on the sustainability, which I will not cover too much. Next, please. I think looking forward, we continue to drive resiliency and also sustainability returns. We will focus on asset management to enhance our current asset, which I think that will certainly benefit the unit holders. And of course, active capital management to make sure that we are able to be on top of the games when it comes to any kind of uncertainties, and also explore any kind of AEI works that will further unlock values to the unit holders. Next, please. I think for that, I will end my presentation. Happy to take any questions from the floor.
Thank you. Thank you, Kevin, for this insightful sharing. We've come to the Q&A session. Can I just invite everybody, an audience, to post your questions in the chat box. And then for Facebook Live audience, you can click on the link and join us in the Zoom and post your question as well. Right now, may I invite Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate our Q&A. Over to you, Ben.
Hi. Hello, Kelvin. Long time
Hi,
no
Ben.
see.
Yeah, it has been a while.
Yeah, I think the last time we spoke was last year in August or September, was it?
Yeah, I think so.
Okay. So we do have a couple of pre-submitted questions, as well as I see some questions coming in through the Q&A function.
Sure.
So I've bucketed them into a couple of big categories. I think we're going to first start off with the financials, then maybe the dividend or capital structure, and then maybe the outlook, as well as the forward-looking growth for Lendlease. Okay.
Right. Sure.
All right. So we have two questions that came in about, asking about the cash flow of the REIT. One of the question specifically cited share investor as saying that Lendlease was or is having a negative free cash flow for most of the recent year. So would you be able to add some color to the cash flow for Lendlease?
Actually, to be honest, I perhaps it's not very convenient for me to comment on any of these share investor calculation models, and also how they derive the free cash flow. Perhaps we are not privy to that for sure, but to us, we always generate positive cash flow, and that's how then we can have a distribution to the unit holders on a regular basis. And so far, if you look at our distribution trend, I think we have been always maintaining a very strong distributions. I think if let's say you don't have a strong cash flow, I think that is something that is not possible to be done. I don't know where and what is the definition of the free cash flows, but happy to know more, and then I can able to share. But at this moment, I think I will reserve my comments on that calculation itself.
Okay. All right. Let's move on to the debt level. So, of course, one of the main concerns by shareholders is usually the debt load that a REIT will need to take on for expansion, as well as for working capital needs. So the question here is, vis-a-vis the current high interest rates and high inflation environment, how does Lendlease, what are the plans for the REIT to manage or reduce its current debt level?
Okay, I think of course the best way or the cleaner way to reduce the debt is really to see any opportunities for you to divest some of the asset that has a lower yield comparatively. I think that is the best way to do it. If not, I think and that is of course the most direct way to sort of straight away improve on the numbers. Of course, I mean there are other ways that I think some of the other peers are doing, is to do fundraising without acquisitions. I think that is the last things that we will do. I think that's not something that immediately what we will consider for sure, because we believe our gearing level, while is actually at close to 40%, which is actually very close to what our peers of the same sectors and same targeted sectors are doing. So I think perhaps that is the fact of the industry. If let's say you're holding asset that has a higher values per asset itself, I think that is when you actually require a stronger kind of gearing to sort of manage, to sort of acquire that and all those things. That is perhaps how it works, and that is the situation. So as to how to sort of manage it on an organic way, I think what we're trying to do is to, of course, continue to enhance the asset to see how we can unlock more values to the unit holders. For GEM, I think for those that follow us, and you understand that we just acquired GEM probably somewhere in April last year. And then shortly after, we do our year-end closings, and we recognize around 2.5% or 3% kind of value increase on the asset itself. That is, of course, based on the performance of last financial year. And this financial year, we continue to see a positive kind of momentums in terms of the leasing profiles, and also in terms of the sales, and also in terms of footfall. So we believe the valuations will continue to either maintain or will increase. So I think we continue to work on how to sort of further enhance the asset itself. I think I did share with in some of the forums that, for example, while our office is actually fully leased to Ministry of National Development, it doesn't mean that the cash flow becomes stagnant. I think what we need to do is to have a sort of breakthrough kind of thinking to see how we can sort of create more values. I think what we do is that we sort of like in the discussion with MMD to see how we can sort of do a subleasing arrangement, which any kind of upside we're happy to sort of share. So in any case, they can sort of, first of all, optimize their usage of the place. At the same time, maybe can bring in some relevant services to the buildings to sort of facilitate, to improve on the efficiency of the building. I think that's one of the things. Of course, the other thing is to see how we can sort of unlock some of the space on tenants, which I think we can move some of the back of house space and then convert it to a lettable space. That is what we are doing. I think we have managed to convert around 1,000 over square feet also for that purpose. I think more importantly is to really further unlock values to create values for the unit holders. And GEM is certainly a good asset that we believe we can do so. And I always use the example of Marche. For Marche, if you are one of the customers to Marche, you know that it's actually you need to actually bring your card to a store, to one of these store, and then get your food and all those things. But I think Marche in GEM, totally you cannot do that kind of concept. It's really you have to place your order in a regular basis, just a normal restaurant, because they don't have enough space for them to do this type of business model. I think that is how demanding on the space usage of GEM and how good GEM is. For that perspective. So for 313, as we also see the improve of the tourism coming back to Singapore, I think that's when the momentum will also pick up, and sales already exceeding by I think pre-COVID easily probably close to 20% or even more. And footfall as it is, we do actually report something of a pre-COVID level somewhere last quarter and all those things. So I think there's opportunity for us to sort of unlock. I think if for those that follow us also you might actually aware that we still have 10,200 square feet of space that had yet to be deployed, and that is given by the government. So as we deploy, it means higher distribution to the unit holders and also higher values on the valuation itself, as we recognize the value through the cash flow method itself. So all this, if let's say we do, it will sure be able to give us some comfort to the interest rate. I think back then in the case to the formula of the interest rate, if let's say you are looking at interest rate that has been increased by around 3% on a year-on-year basis, and if let's say we have hedged around 61%, then the effective increase is about 1%. Am I right to say that? So, but if for those that also understand us, you know that we have this annual escalation inbuilt into this our leases itself. Almost all our leases about 3 to 4%. So if let's say you look at that perspective itself, net will still be a cash inflow. That means if you take you just probably take a 3% increase, but minus off the impact of an effective increase of interest rate of about 1%, you will have a net inflow of around 2%. And of course, our borrowing is only 40%, but there are still a 60% that will enjoy a 3% increase. So in the case, if you look at this perspective, I think hopefully I can give the audience here some comfort that, I mean, on a cash flow perspective, actually is a positive kind of momentum instead of, well, I mean, the interest rate do actually increase, do affect a lot of REITs, but it's the underlying performance of the portfolios that actually give the assurance to the unit holders that the REIT can able to deliver and able to give the regular kind of distributions.
Okay. Staying on the subject of interest rate and alluding to or following up with to what you mentioned about hedging the interest rate, there is a question here. If, let's say, all the debt, including perpetual securities, are included into Lendlease, how sensitive is the debt for Lendlease, to interest rates, since they're quite high now? And also, yeah, sorry. So go ahead first.
Yeah, go ahead. Okay, basically, of course, I think perpetual is something that, of course, it will have a fixed coupon. So in that case, that will not adjust based on the changes of the interest rate environment. And usually, we will only distribute after the perpetual coupon distribution. So in that case, what we have so far distributed is already net of the perpetual impact to that. So as you can see, our trend of distribution and it continue to be at that kind of positive momentum, then I would say that the perpetual itself, while it's one of the ways that we raise funds, it is not going to affect the distribution significantly because it's a fixed component. And of course, perpetual do actually, to certain investors, it's a higher cost of debt, but to us, actually, it's a way to sort of manage the acquisition as when we acquire GEM. At the same time, it actually is a good way to sort of balance between a debt and equity. And as to how we look at it, perpetual in relevance to borrowing, and then how would that reflect in a gearing? I think I try not to sort of confuse the audience, because from the MAS perspective, perpetual do actually is recognized as equity. So we are looking at that. I mean, we do not actually sort of want to actually put it into the gearing perspective. But I think if you want, you can actually easily do your calculation also, not too difficult to do so. But I think I just want to respect how MAS calculate the gearing ratio. So I think we will not change that number as it is to confuse the audience.
Okay. And I assume, typically perpetual debt have a what you call a buyback, right? A buyback option.
Yes.
So I'm kind of like guessing that when interest rates drops, you can refinance at a lower rate. I don't know.
Yes, I think, yeah, but of course it's depending on when is the maturity of the perpetual itself. And of course, the other ways to fix it is to see how we can, as I mentioned, is to do a clean cut ways to sort of like maybe look at your asset portfolio and see which asset, I mean, is good to sort of unlock values or recycle cash to sort of like balance it out. And there's, I mean, everything is possible. For example, even the GEM asset that we acquire actually make out of office and the retail, we can sort of like break into two pieces, and then we probably sell the office and then maintain the retail, or we can even sell the retail and maintain the office. I mean, depending on what makes very good sense for us. But I mean, the most important thing is to see how's the best way to address any kind of issue that we have. But most importantly is to max out the values that you can actually have by holding the asset before you consider this diversity. I think that's the objective of what we are trying to do. So while borrower or lenders still consider us as having a very strong portfolios, I think that is something that we can actually sort of take a back seat at this moment, but continue to enhance the value of the asset. Once the asset is actually max the value, that's where we actually feel like we can actually divest the asset. I mean, but everything is possible. I think that everything has solutions to it. I think our asset is strong. I think we believe that there is always a way for us to deal with that. So we are not at that kind of desperate situation yet.
Okay. I mean, certainly, GEM is quite a good property.
Indeed it is. Yeah.
Right. Okay, so let me see. One last question, very specifically about the debt, or rather a couple of questions actually. So what is the adjusted interest coverage ratio for the REIT? And would management be able to add some color on how they plan to increase this ratio? I think you've already spoken quite a fair bit about it.
Yeah, I think I have spoken quite a fair bit about it. And again, is that this adjusted ICR, well, again, is something that people look in at. I think what it actually means to the audience, or rather the people here, is that is a formula that include even your upfront fee that you pay and all those things. So it relevant, but it might not be totally relevant per se. So but of course, most importantly is to see how's the underlying performance of your asset. If you continue to generate very good kind of returns and all those things, I think that's when I think investor can seek comfort to it. And also, to be honest, the only things that I feel the adjusted ICR is relevant is that whether it kept you on how much you can sort of gear up. I think at this moment, I think it kept to 45% because our ICR is at 2%, 2 times. But it doesn't matter, because as long as you maintain a discipline that you will never go gear up to that level, I think that is just a target that you don't. I mean, you are there, but you don't need to actually sort of worry about it too much. I mean, that's the only thing that I think is relevant. But other than that, the calculation itself actually is I would say it actually doesn't really measure your ability to sort of pay up your interest rate when it comes to the stress issue and all those things, because it actually include other thing else in the formula, which actually to the banks is not relevant. So the more, I would say that the more the rightful ICR that the investor should look at is the interest coverage ratios to the banks. That's when the bank seek reference to, and the bank stick to make sure that you are healthy enough to pay my interest. I think the 4.6 times is to us is the relevant number, and that's how we sort of like make sure that we able to fulfill that covenants. Other than that, I think that is a good formula. That's a good number that people take reference to. But I think that is probably the way that government, or rather MAS, try to so sort of cap your exposure with all things that is added in. But the all things that is added in, whether it's relevant or not, I think again, I do not want to comment, but it do actually include upfront fee that you already paid. So I mean, the question is back to you guys whether it's relevant or not.
Paul, rest, Kelvin, just now, my attention was kind of split because I was looking up the Bloomberg terminal. So you may be happy to learn that Bloomberg thinks that the default risk for Lendlease Global Commercial REIT stands at 0.4%, one of the highest or one of the lowest default risks, and Bloomberg has ranked you as second highest in terms of their proprietary risk.
Thank you so much. Yeah, I think that really give I think the audience here some good comfort and understanding. I think hopefully you believe in Bloomberg. I believe in Bloomberg.
you got terminal or not? Then you should look this up and then tell all your investors.
Yeah, I think it's a good point. I think thanks for the tips.
Okay. So again, caveat to all our friends out there, obviously Bloomberg has got its own system, but this is one of the screening that we at SIAS do as well. So obviously for companies like Hyflux and all that, we kind of, it was already on the radar before it happened. But anyway, so good stuff. So moving from interest coverage ratio to one last question about the financials before we move on. Again, coming back to the context of rising interest rates, which I think could actually be moderating. But if let's say interest rates were to continue rising in the next 12 months, how do you think the valuations as well as the market capitalization rates that you're using would change?
Honestly, I would think that as long as our performance of the asset continue to be positive, the momentum of rent reversion continue to be positive, I think that can be managed and dealt with. to be honest, now we are actually, US already raised the rate so close to the target rates. How much more they can raise? I mean, that is the questions that we have to frankly ask ourselves, and don't be eluded by all the negativities and believe that that is something that is going to fall onto you. I mean, more importantly is that whether the portfolios will continue to able to perform. To be honest, we are just at the start of how we feel that the rental reversions can continue to pick up. For example, when we talk about the sales of the mall has increased by 20%. So what did it translate to you on the ops cost? Ops cost means how much of the rental that the tenants pay to you divided by their overall sales. So if the sales number increase, that means the base increase. That means you have the flexibilities or abilities to increase your rental because the operation of the tenants actually has been improved. I mean, that's how we are looking at it. So we are looking at easily, I mean, you based on the 20% of increase compared to the pre-COVID number, that means that you have probably a bandwidth to increase. So that is just the start of how we recognize the positive momentum of the rental reversions. If you are so worried and so concerned about the interest rate environment, then I think, of course, you might actually miss the opportunities. But if you believe the interest rate already reached to a peak or is going to the peak, I think that's where you should start to see what is the best time for you to pick up the stock and say, okay, maybe it's a good time for me to just go on with it because of the positive momentum and on the retail scene. I mean, all the audience here, I believe, are from Singapore. It's so easy to go and see whether your asset or our asset is healthy or not. I mean, by just visiting the asset. So it's more than what I tell you. You can go and experience yourself. That's what the beauty of us bringing the Singapore asset to the portfolio is, to make sure that we are transparent to the investors, and investors are able to continue to sort of have a close contact or stay on pulse to what our performance of the asset is. So I believe our asset is continue to perform well, and I think while interest rate continue to be a challenge, but I will say that I think the upside is limited. So in that case, as long as we continue to stay a positive kind of rental reversion uplift, I think that is something that the audience or investors should stay comfort about it. So maybe I also look at maybe share with you on a quarter-to-quarter kind of rental reversion. If the first quarter is 1%, we recorded a 1% rental reversion. I think second quarter we record around 2% or 2.1% or something like that. And
that's quarter on quarter, is it?
That is actually year to date. So in that case, if you look at on the third quarter, we moved from 2 point something to 3.3%. The incremental is actually more than 3%, of course, right? I mean, because you need to actually make good for the previous shortfall of the 2 quarters. So in that case, the actual rental reversion on the quarter itself, I would say probably is 4 to 6% or even higher. So look at it and seek comfort of the performance of the portfolio is more important than you focus on the interest rate at itself. Actually, to be honest, there are, of course, REIT that is lower geared, there are REIT that's over geared. But the thing is that what makes the best use of your money that you invested in is how you run with a geared as a fund, but it still continue to perform. You can be lower geared, but your asset is not performing. So what? Right? I mean, doesn't mean that you got a positive distribution. It's just probably at this moment you feel that less worried. But the thing is, the asset is not going to perform anyway, right? So it's look at the performance of the asset. This is the focus that the audience should look at and stay in touch with the pulse of the asset. And that is why our asset is in Singapore. It's easy for you to seek reference to.
Okay, so for our friends out there, possibly we may have another 0.5% upside to the US Fed funds rate. That's one of the presidents of the regional Fed mentioned in a news article. But that's 0.5% over the course of the next few months. And we do expect interest rates to fall starting from 2024. So this could very possibly be peak inflation and peak interest rates.
Yeah. Thanks, Ben, for sharing that.
Yeah, also, educate people. So
Yeah.
All right.
Work from you is better than work from me. I mean, that would be true, right? Because you're more of a third party.
Yeah. It's part of a job also, educate. Okay, next. Dividend. All right. So a lot of interest around this topic. So what is the dividend strategy? How is your dividend strategy impacted by the high inflation and perhaps the again the gearing? So maybe you could add some color to that.
Yeah. Very funny is that actually, I mean, some of the institutional investors are very comforting to tell us that hey, as long as your dividend policy don't drop, we are more than happy. But you see, most of the REITs, they expect to drop and all those things. I think while we cannot give them a forward statement or we cannot share something that is non-public, but what we do actually, as I share with you, is that we believe the ops cost will come in place nicely for us to sort of like manage the rental reversions going forward. I mean, that's what we believe it should stay momentum. And also, if let's say the rental reversion, you feel that is a bit too much for you to understand, look at our inbuilt kind of rental reversion on an annual basis. Again, that is also one of the way that you can seek comfort. So with that, and you look at the interest rate, effective increase of the interest rate because we have hedged 60%, probably that also give you some understanding that, hey, actually the situation is not that bad lah. I mean, I always tell people, it's good when it comes to a crisis, two things you need to manage is that your top line. Your top line, is it still performing? If it's not, how do you address that top line? Because top line is a survival number. If your top line is not performing, even you call to manage your cost, your interest costs, expenses costs, cut down all those things, actually that is it just probably prolong your sustainabilities of survival or all those things, but it doesn't actually help your underlying ability to survive. So top line is a survival number. So that's how I'm trying to emphasize. Look at the top line, whether you still be able to survive nicely, perform well, and all those things. That is key. I think, of course, when it comes to these sort of issues, look at your balance sheet, whether your balance sheet will be compromised, and that's where the valuations become important. And I think as the asset will perform, I think the valuation is less of concern. Well, again, I do want to say, because I'm from the REIT itself, but I think you look at maybe other peers that have already reported their annual reports, reported their annual results in December and March. I think, did they actually drop any values in the Singapore asset? I think probably the answer is no, and some even increase. So I think that hopefully also give you some comfort to the valuations itself and the stronger the balance sheet that we have. So if let's say these two are being addressed, so I would say that our distributions, back to your question, our distribution will continue to maintain a good momentum. I don't want to make a forward statement here because if not, MAS will kind of look for me. But I think we will continue to be able to have a very good kind of momentum. Of course, we do actually want to see a kind of positive kind of distribution momentum. But of course, there are also things that we need to sort of cultivate and involve. And for example, to unlock the 10,200 square feet of space that we might not to conserve some cash for that purpose and all those things. So I think all this being said, I think the performance is good. The distribution shouldn't be too of a disruption. Shouldn't be too disturbing to the investors.
Okay, so putting on my hat as an analyst here, again, just looking up the data that we have. The 12 months yield for Lendlease stands at 7.37%. The indicative 12 months yield is closer to 8 lah. So take it as take it as what you will. Yeah. Okay. So again, REITs normally pay, I don't know, between 6 to 9% distribution yield. Anything more than 9% would be, I guess, too good to be true. Anything less than 6, maybe Singapore savings bond might be a better idea. But anyway, so this is kind of like within the normal range, I think.
Yes.
Oh, okay. All right. And again, Kelvin, So we have not come to the end of the question yet, but we always get a lot of questions on financials because obviously we Singapore have got a huge portfolio, and we are Singaporeans, so we tend to look into the details. Okay, so moving on, let's talk about the outlook as well as growth. So a lot of questions about your Orchard Road 313, the 10,200. Is Live Nation on or not on? What's happening there? Give us some color. Is Beyonce coming?
Okay, the 10,200, I think we are actually on a planning phase. I mean, when it comes to when something become more real, we're happy to share with the investors and probably make an appropriate announcement so that investors know what is going on and how we sort of unlock the values. I think now is that with the as we just came out from COVID, we tried not to have too much disruption of the traffic, the flows and all those things. I think that is all into consideration, but I think it will not be too long for us to come up with plans to sort how to unlock their values. Give us some time because we just want to make sure that we have to clear the authorities of the plan before we can sort of make announcement or plan something that can be something that we can sort of deliver. I mean, instead of just giving you a plan that, I mean, at the end of the day, it will change, right? So I think that's one. Okay, for the Live Nation, the empty Greenshoot space that we are talking about, I mean, I believe at this moment, I don't need to tell everyone, but everyone knows that Live Nation is our anchor tenants for the space. Okay, I think what we are doing is really first of its kind in Asia or perhaps in the world that having entertaining and multifunctional space in the midst of a world shopping belt itself. It's really at the center of the whole shopping belt. So it's very interesting, but again, it also means something that is a breakthrough to the Singapore in terms of getting the authority approvals and all those things. It's a different ball games, to be honest, and there's something that we need to sort of clear a lot of different authorities to make sure that things are in proper for us to sort of move ahead. So we are actually close to the starting line. Actually, I think once we sort of I think we are anticipate that, I mean, we will be able to get it clear by probably beginning of second half of next year. So this year, second half of this year, which is probably
quite soon.
July, yeah, quite soon.
Yeah.
I think with that, they probably take around 12 months or 18 months to sort of deliver. I think that is how it's supposed to work, because we want them to be more, or rather the government actually want it to be a more elaborate kind of structures that can house and also be safe for people that go to the place. It's not like a container and that's it. It's a very elaborate kind of design and all those things. Of course, I can't share too much, but certainly it's a huge investment. Okay, then you talk about the investment sum. Basically, I think the beauty of us collaborating with Live Nation is that we actually invest no money to that construction. The Live Nation is going to pay for the construction work. At the same time, once it's done and run, and they were going to pay us a regular kind of renter with some, with also a profit sharing kind of mechanism. So I think I saw one of the questions is asking how much the yield of the Live Nation partnership. I would say it will easily be a double-digit kind of yield once it start off. So it's a good win-win for us is that Live Nation pay for it and Live Nation continue to pay us rent. I think what we need to do is just continue to be a faithful owners to the land and facilitate them on the performance and all those things, and not forgetting the synergies that we can generate from the site to 313. Given that, I mean, there's a lot of collaboration, and also we have this Lendlease app that we can sort of input and also let the maybe even have the exclusive sales to the members for whatever live performance that Live Nation have. I think that's the beauty of it. Yeah. I think the last point I want to try to elaborate to a lot of different investors is that, I mean, people like Live Nation, basically they are event organizers. So most of the time they just go to a venue and then they maybe list out a space of 5 days or 3 days for the events, and then they go away. So but the venue itself become empty. Let's say no one leaves the space. But now Live Nation invests in it, and they are also event organizer. They will make sure that they run as much program as possible and generate as much revenue as possible to sort of keep them going and make sure that the investment is the right investment. So for that mechanism itself, Live Nation become they don't own it, we are own it, but they are the tenants that pay for it, and then at the same time they generate events. I think they will generate a lot of events that is going to have a benefit for 313 being around there, and benefit the tenants at the same time, make the place very interesting. I think that is the formulas that we're trying to work with Live Nations. And yeah, and of course to Live Nation is a good location. To them is, imagine we are so near to the train station, middle of Orchard Road, so easy for them to be recognized by the world. I mean, being in the world shopping belt, I think it's a win-win for both. But I think to us and to our investors is a less of a capital investment, but more of the yield play that we are talking about.
Well, I mean, certainly, I'll probably be making fuller use of my Hai Di Lao membership. So I'll have dinner at 313, then I'll pop over to watch Taylor Swift. Yeah,
it will be very interesting. I think we must provide maybe more different kind of cuisine for people from different places come to Singapore.
Okay, okay, but
yeah.
Anyway, okay. So all right, next. Okay, so we talked about a specific piece of property in Orchard Road. Now, on an aggregate basis, so we've got a couple of questions. Things like Parkway Parade Shopping Mall, is it going to be injected into the REIT going forward, or more of a general Singapore strategy? What are your growth plans for the Singapore property over the next 3 years? How do you intend to compete with Maple Tree, Capital Land, so on and so forth?
Of course, I mean, to us, I think the good thing is that our sponsor do have a lot of pipelines, and of course, pipelines in Singapore itself, I mean, including all those that we have partnership with, and all those things actually added up actually easily to be around probably another 8 billion or so, to be able to sort of like consider it to be the REIT asset for sure. And of course, don't be worried about our name, Global Commercial REIT. I think we are also concerned and also want to hear from the investor what is the best asset that we need to put into the portfolios to sort of give them the confidence of our REIT. So I think what we have here from a lot of investors that they prefer more Singapore asset. Of course, they understand that Singapore asset is more stable, I think, from the global perspective, and also they do see that I think the Singapore retail probably are stronger and more resilient to the business environment surrounding the area, surrounding the regions, and even further the region. So I think our focus will be more on Singapore. Of course, has to be conducive and make sure that we sort of like acquire at the right time, or it could also be acquired at stages. That's what we do in GEM, so that in that case people get familiar with the asset that we have. I mean, comfortable with cash flow, then we try to acquire at different stages to sort of make it 100%. So we can actually also do so. So I would say that in the near terms or even short terms wise, we will probably, if let's say anything that we will consider acquiring, will be anything in Singapore. And of course, retail scenes continue to be positive. And I think that's what we should actually stay focused in, so that in the case to sort of capitalize the positive momentum to that perspective. So I think some of the audience did mention about PLQ and 313, PLQ and Parkway Parade. I think, yeah, I mean, they are still something that we can strongly consider, but it has to be something that it has to be something that has a positive accretions that we saw before we can bring it to the REIT itself. So a lot of things need to sort of fall in place, but these are the two assets that we feel, I think so far has been mentioned by a lot of investors, and also a lot of investors continue to like the asset, and we believe that at the right time we should bring it into the portfolios.
Okay, good. There is a specific question about the assets in Italy. So how is the renewal of the Italian assets coming along ahead of the break clause? And and I believe the asset is maybe office. So how is that affected by the hybrid work arrangements?
Okay, so far the break clause is in 2026, and of course we didn't hear anything from Sky Italia itself, but everything is contractual. I think any changes we make sure that they will have to inform us earlier, because contractually they need to notify us earlier if, let's say, they want to break it. But as I mentioned, I think there are a lot of things that they need to sort of consider, because the break clause itself means that break of 3 buildings is not optional 1 or 2 buildings. So even with the change of the working style or hybrid working environment, it doesn't mean that you allow them to sort of break 1 and then stay in 2 and all those things. So these are things that is something that they have to be in a total considerations. I think the beauty of our site is that it actually going to have I think by 2026 or somewhere around there will be a Olympic kind of events and all things that will be hold around there, and it will of course make the place strongly relevant. But of course, our 3 buildings is also recently being got this LEED Gold certifications, which actually is getting important to a lot of tenants in Italy. They start to move out older buildings, which is less, which they cannot get green certifications, to the newer buildings. And also we have a very strong efficient floor plate. So if, let's say, that going to trigger, actually it's not going to be a big issue for us. But the thing is that, of course, we so far didn't hear anything. I think we continue to stay positive on that. I think the last thing I want to mention is that recently there's 2 new development. Actually, they have been developed for a year or so, and is anchored by one of these very strong kind of engineering company, which is called Spark 1 and 2, and the rate that they actually command is around 320 per square meter per annum, euro dollars. But currently we are actually charging Sky around 188 square meter per annum. So I think there's also a rental differential which actually sort of hold them back on any change. I would think so. And I think also that location is very well connected with the train and the metro station and all those things. It's very convenient. So I believe the location is good. So if, let's say, there's any change of plan of Sky, I think we will not have very strong concern about filling it up. But at this moment, we didn't hear anything, and also if, let's say, they have to break 3 buildings. So all this is not our consideration. It's more on Sky considerations on how they want to manage that.
Okay. All right. So, ladies and gentlemen, we have run out of time. Now it's 33 minutes past 1. From my perspective, I'm going to leave you with one other item. So you have a bunch of research analysts in Singapore, DBS, Bank, UBK here, and Phillips, so on and so forth. They are covering Lendlease Global Commercial REIT. Do encourage you to go and take a look at this research reports, and I think you'll get a much fuller picture on the financials. Already you can see just from one glance the consensus is actually quite good.
Thank you.
All right. Yeah. So Calvin, you should get yourself a Bloomberg terminal. For our friends out there, go and get the free research reports.
Yes, good idea. Yeah.
Don't lie. All right. So thank you very much, Calvin, for joining us.
Thanks,
I'm going to pass the time over to Eileen. Always fun to speak to you.
Sure. Thanks, man.
Thank you, Kevin and Ben, for the lively Q&A. as a Northlander, well, Jurong side is always a go-to place for me as well. So just keep up the vibes, and of course the traffic has always been very encouraging over the weekends. So it's a matter of like getting the right tenants and the vibes together. Okay, we've come to the end of the Corporate Connect session. If any of you have any additional questions, feel free to contact their IR department, and also of course through SIAS. We always welcome any questions that investors may have. In case you miss any part of today's session, you can rewatch the webinar on SIAS YouTube channel. So Corporate Connect is a monthly webinar. Do visit our website and get updates on the upcoming investor education programs and initiative. And I also want to urge audience over here, if you have any companies that you may have in mind that you want us to feature, do type in the chat box now, so that we can also reach out to the companies as well to be featured. The next upcoming Corporate Connect session will be featuring first week on the 27th of June. So thank you once again and have a nice day. Bye,
Thank you,
everyone.
everyone. Bye-bye.
Thanks, Calvin. Always a pleasure.
Thanks, Ben. Thanks, Elaine.
Thanks.